The EV battery boom is now destroying automaker capital. The EV battery boom is now repricing capital. Ford, General Motors, Stellantis, and Honda have disclosed tens of billions of dollars in impairments, contract cancellations, and program losses tied to electric vehicles. And the pattern says more about capacity built for a demand curve that changed than about any single company's execution. The first phase of the electric vehicle transition was defined by a race to secure battery capacity. Automakers announced factories, formed joint ventures, committed to long-term supplier contracts, and designed vehicle programs around demand forecasts that assumed electric adoption would keep accelerating. The second phase is being defined by the cost of reversing those decisions. Ford, General Motors, Stellantis, and Honda have now disclosed tens of billions of dollars in impairments, contract cancellations, program losses, and restructuring costs tied to electric vehicles and their supply chains. Several battery joint ventures have already been sold or dissolved. Multiple vehicle programs have been canceled before launch, in some cases months before their scheduled production start. And manufacturing assets that looked strategically indispensable only 2 or 3 years ago are now being valued at a fraction of what automakers originally paid for them. The pattern suggests these losses reflect more than a short-term sales slowdown. It shows what happens when capital-intensive manufacturing capacity is built around a demand curve, regulatory structure, and product strategy that all change before the assets reach full utilization. Automakers are paying to unwind capacity. Ford's reset established the scale of the exposure. The company disclosed an expected charge of approximately $19.5 billion as it canceled or reworked electric vehicle programs, shifted resources toward hybrids and lower-cost EVs, and reorganized parts of its battery manufacturing strategy. That figure blends several different kinds of losses, including EV asset write-downs, Blue Oval SK restructuring costs, program cancellation costs, and future cash obligations. Only about $5.5 billion of the total is expected to actually affect cash. General Motors followed with approximately $6 billion in additional fourth-quarter charges connected to its EV manufacturing realignment. About $1.8 billion of that involved non-cash impairments. The larger portion, approximately $4.2 billion, covered supplier settlements, contract cancellation fees, and other obligations with a cash impact. GM also warned that additional, though smaller, charges could emerge during 2026 as negotiations with its supply base continued. That distinction matters. An impairment reduces the book value of an asset. A contract cancellation means the company still has to transfer cash, because a supplier invested, reserved capacity, or purchased materials based on production volumes the automaker no longer expects to need. The loss is therefore not contained inside an assembly plant. It moves through the cancellation clauses buried in long-term supplier and energy contracts, the same mechanism that has been reshaping corporate energy agreements this year. Stellantis put a price on overestimating adoption. Stellantis disclosed approximately €22.2 billion in charges, citing weaker than expected EV demand, changing regulation, supply chain restructuring, warranty provisions, quality costs, and workforce restructuring. Management acknowledged that its earlier adoption forecasts had proven too optimistic, but that was one factor among several rather than the sole driver of the total. The battery restructuring behind the number included Stellantis' exit from Nexstar Energy, its Canadian battery joint venture with LG Energy Solution. Stellantis sold its 49% stake to LG for $100, effectively relinquishing its ownership for a nominal amount. That exit is significant because Nexstar was not an exploratory investment. It was one of the flagship battery plants announced during the first U.S. and Canadian EV manufacturing surge. Selling the stake for a token sum reflects a change in how automakers value direct control of battery supply once projected vehicle volumes no longer support the original capacity assumptions. The write-down does not mean Stellantis is abandoning electrification. It means the company is no longer willing to preserve every investment made under its earlier strategy simply because those investments once appeared necessary. Honda's losses show the risk extends beyond factories. Honda's March reassessment pushed the same issue into vehicle development. The company canceled 3 EVs planned for North American production, the Honda Zero SUV, Honda Zero Saloon, and Acura RSX, saying that launching the vehicles under current demand conditions would likely produce additional long-term losses. Honda estimated that total losses tied to its electrification reassessment could reach $2.5 trillion, or roughly $15.7 billion, and acknowledged that concentrating resources on EV development had weakened its competitiveness elsewhere, particularly in Asian markets, where newer manufacturers moved faster on software. This is not just a stranded factory problem. Capital destruction is also occurring in engineering programs, tooling, intellectual property, supplier commitments, and vehicles that will never reach a customer. A widening definition of stranded investment that has also shown up in corporate energy efficiency programs, falling short of their targets this year. Battery joint ventures are losing their strategic immunity. Battery joint ventures initially solved several problems at once. They let automakers share factory costs, secure access to cell technology, qualify for regional incentives, and reduce dependence on imported batteries. But they also locked partners into shared assumptions about chemistry, factory location, vehicle volume, and timing. When those assumptions changed, the partnerships proved harder to unwind than an ordinary supplier contract. GM sold its interest in the Lansing, Michigan Ultium Cells facility to LG Energy Solution as part of its capacity reduction. Stellantis left Nexstar entirely. Ford restructured its Blue Oval SK partnership with SK On, bringing the venture's two Kentucky battery plants under full Ford ownership through a wholly owned subsidiary rather than continuing to share control. None of this means joint ventures themselves have failed as a structure. What has changed is how much automakers are willing to lock in. Ownership arrangements are becoming more flexible, capital discipline is increasing, and automakers increasingly prefer optionality over the largest domestic footprint they can finance. The losses are repricing future factory announcements. The most important consequence will not appear in the write-down totals. It will appear in the conditions attached to the next round of investment. Boards and finance teams are likely to ask for smaller initial manufacturing phases and more flexible production lines, so a plant can scale toward real demand rather than a forecast. Contract terms are shifting alongside that. Firmer vehicle volume commitments, supplier agreements with lower cancellation exposure, and flexibility across battery chemistries, instead of a single locked-in cell design. Some of that flexibility means building in a clearer path to hybrid or energy storage production if EV volumes don't materialize on schedule, with tighter return thresholds required before anyone signs off on the next expansion. Honda has already said it will impose stricter investment caps and monitor post-investment earnings more closely. That is the real transition underway. The industry is not moving from EV investment to no EV investment. It is moving from capacity-first investment to return-first investment, part of a broader recalibration toward return-first capital planning across the wider energy and industrial economy this summer. For battery suppliers, construction firms, states, and communities competing for new plants, that change reduces the value of an announcement that isn't backed by firm production economics. A multi-billion-dollar factory commitment no longer guarantees that every planned line will be completed, operated at scale, or remain under the ownership structure originally announced. The first phase of electrification rewarded companies that secured capacity before their competitors did. The next phase is rewarding companies that can scale investment without locking themselves into demand assumptions that may not hold. The largest losses announced this year suggest that flexibility, rather than maximum capacity, has become the more valuable strategic asset. And that is what ties Ford, GM, Stellantis, and Honda's very different write-downs back to the same underlying cause. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.